Hi, Pramod. We are live.
Hello and welcome to Marcellus's webinar on our flagship strategy, Consistent Compounders. I have with me my colleagues, Rakshit Ranjan, who's the portfolio manager of Consistent Compounders, and Saurabh Mukherjee, who's the CIO. Today's webinar is on a special topic because it sort of hits at the crux of what we do here at Marcellus. By now, many of you would be very familiar with our investment philosophy. Simply put, we're playing in arbitrage on the longevity of businesses here because we do genuinely believe that great businesses tend to remain great for far longer than what the market tends to appreciate, and we would like to capture that anomaly. You're familiar with the longevity framework. Couple of key aspects of the longevity framework are discussed in this webinar, which is based on the beautiful newsletter that my colleagues have written of late, which is capital allocation and succession planning, how the two tie in together to create a self-fulfilling loop is what creates longevity in firms. So to tell us more about it, I'll hand it over to Rakshit. Over to you, Rakshit.
Thanks, Pramod. Good afternoon, everyone. Thanks for dialing in. Let me just share a set of slides first before I begin. Right. Pramod gave the context. Before I dive into it, let me quickly also give a little bit of update on the portfolio performance. So this is how the fundamentals of the portfolio have performed over the last few years and more recent past as well. So the top 4 rows are consistent compounders, weighted average fundamentals, and the bottom 3 rows are Nifty 50 weighted average, Nifty 50 fundamentals. You'll notice a very consistent and wide gap between the return on capital employed of the CCP portfolio, which is roughly 40%, versus the return on capital employed of Nifty 50, which is roughly half of that. That wide gap is the starting point of why we believe the portfolio we've constructed is a high quality subset of the broader market. That then boils down through reinvestment of capital generated out of high ROCE. That reinvestment of capital drives growth, and when you look at FCF CAGR and PAT CAGR and compare the rate of growth of, let's say, profit after tax of consistent compounders with the rate of growth of profit after tax for Nifty 50, again the gap is pretty wide and consistent, and that wide gap ends up being the reason why over the longer periods of time we expect performance of our portfolio to be superior versus the rest of the market. So that's comparison with Nifty. When you look at it in an absolute manner, this is the summary of FY23 profit growth, which is roughly 20%. So bottom right corner of the slide, backed by revenue growth of 19% in FY23. Remember, FY23 growth rates of revenue and profit are on a reasonably normal base of FY22, which also had a very healthy mid-20s to closer to 30% growth in revenue and profit. Now you might argue that the COVID period of FY21 offered a low base effect that benefited FY22 a bit, but FY23 didn't have a low base effect, and on top of a normal base, 19-20% revenue and profit growth is commendable. When you compare that against how the share prices of our portfolio companies have done, as we've highlighted in some of our previous communication, there's a massive gap which has opened up. We quantified this gap about 3-4 months ago, that it was as wide as 35 to 40%. In the last 3 months, there has been a reasonable catch up. I think 18-19% is the absolute return in the last 3 months, which is about a 6 to 8% alpha over Nifty 50 in the last sort of 3.5 months. So some of that gap which had opened up between fundamentals growing at a much faster pace than share prices over the last 2-3 years for our portfolio companies, some of that gap has closed down. Still a long way to go before we say that fundamentals and share prices have moved in tandem. And hence we expect the gap to close down further in the months and quarters and years to come by, if not years, hopefully months and quarters, and hence very confident of being able to deliver a healthy outperformance and healthy absolute return in the say high teens over the longer term for consistent compounders net of fees and expenses. So that's on the portfolio level. Now coming to the subject matter under discussion for this webinar, as Pramod contextualized. Let me add a little bit more to the context. So consistent compounders, as most of you know, invests in companies which have already had longer than a decade of consistency of greatness. Greatness being defined by a healthy rate of growth and healthy return on capital employed. What that also means that many of these businesses have become very large in size in most cases. Not just in absolute terms, they are also large in size at times relative to the size of the broader industry, right? And hence, one of the most frequently asked questions that we've had in the last 5 years of managing our clients' money under this philosophy is that isn't it the case that large dominant companies, they run the risk of stagnation, right? Which is exactly the subject matter under discussion here. The moment you talk about stagnation of a high quality business, right? Assuming the quality of the core business is sustained, stagnation comes typically from two sources. The first source is saturation of the market opportunity itself, where the market shares might be exceeding 50-60% in the said industry, and hence obviously market share can't grow beyond 100 mathematically, and hence there's a ceiling that you're about to hit after having become a large dominant firm in an industry over several decades. The second source of stagnation usually comes from disruption from new competition, disruption from new ways of catering to consumer demand in a particular industry, and hence it is actually correct to be wary of the fact that companies that have had several decades of greatness in the past might be running the risk of saturation or disruption, right? And that's a risk that we try to very consciously avoid when we build the portfolio of consistent compounders. Now, let me just highlight this with a couple of examples. So left-hand side example is, let's say, that of saturation in the Indian context for a firm such as a Colgate-Palmolive, right? In India, Colgate has historically benefited from increase in penetration of oral care, toothpaste in particular, and also increase in frequency of consumption, where instead of brushing once a day, larger part of the population has been brushing twice a day incrementally, and that has provided growth in the opportunity set for Colgate and market share as well. Now, having said that, today Colgate has more than 90% penetration of the category itself. As in oral care's penetration is more than 90% in terms of the households. It has replaced tooth powder, it has replaced Datun and all of that. And Colgate's market share is 60% there or thereabouts, right? And hence, when you look at the last 5 to 7 years, there's a slowdown in volume growth to low single digits, broadly speaking, and that's the sort of culmination of that risk of stagnation due to saturation of the growth potential. The right-hand side is another example from a different reason, where when you look at the last 100 odd years of global automotive industry, right, it's quite interesting that the industry has gone through various phases of evolution in terms of what defines dominance, what defines greatness of the winning company, and there's been disruption done by non-incumbent players usually, right? So for instance, Ford Motors established its dominance about 100 years ago by introducing mass production with the first moving chassis assembly in 1913. And that had transformed manufacturing of automotives globally, and Ford created its dominance. 3 or 4 decades later, it started to lose its dominance through the 1950s and 60s, when General Motors won market share by widening the range of its car models through product-specific assembly line that you see mentioned here. And then a few more decades later, Toyota started winning market share from the likes of General Motors by bringing very novel and compact cars to the market. And more recently, most of you would have seen what the Teslas and the BYDs of the world are doing through electric vehicle adoption to the incumbent dominance of even a Toyota, right? So that's a great example of how stagnation in growth might occur because your greatness gets challenged by disruption after you've become pretty large and dominant, right? Now, what do we do to first of all be conscious of it, track it, and then avoid it? Now, first and foremost, let's just be aware with a few examples of why this happens, right? So we've seen the examples of Colgate and the automotive industry. There are a few others here on this slide. They're broadly speaking two reasons why great businesses, they can't innovate, disrupt, expand into adjacencies to avoid stagnation of their business through saturation or disruption, right? The first example is that of, let's say, innovators dilemma, as Clayton Christensen had coined the term in his book. Christensen is actually a Harvard professor, late Harvard professor. He wrote a book called The Innovator's Dilemma, when new technologies cause great firms to fail. And in that book, he said that sustaining technologies which lead to incremental improvements in existing products becomes quite difficult, because companies they innovate due to disruptive technologies, and hence when the innovation process needed to kick off, these companies find the resource allocation to new innovation initiatives being inappropriate. So effectively, a large business with a great running core, high cash generation, finds it difficult to seed an innovative idea because the innovative idea is loss-making. It's small, probably it might or might not be successful, and hence, whether it be in terms of human manpower or tangible capital, enough resource allocation to the innovation doesn't occur. By a large company, the innovative areas, they get ignored, right? So that's the innovator's dilemma. The second type of example is where adjacencies don't get created. So if you look at Nike versus Reebok, through the 90s, Reebok lost out to Nike because it couldn't move beyond shoes, and Nike moved beyond shoes into t-shirts and various other kinds of sports merchandise to gain more and more market share in the sportswear category. Now, what this in effect leads to is companies that end up solving for the risk of stagnation are the companies that create multiple S-curves internally, and companies that lag behind are the companies that don't invest in creation of S-curves. Now, what are these S-curves? So the chart that you see on your screen, the dotted lines are the new initiatives. Companies that deploy enough resources behind the new initiatives, they might create several S-curves, which elongates the solid line, which is the growth of the overall franchise. Nothing but a culmination of several such S-curves. And typically, these new initiatives or S-curves are around one of these three areas on the right-hand side of your screen: innovation, disruption, and adjacency. Now, why do some companies succeed in innovating, disrupting, and carrying out adjacency expansion, and why do some don't? Right? There are two reasons. One is obviously you need to have the entrepreneurial decision making at the top, a key leader who allocates some capital towards a new initiative. But there's a second reason, which is where I think the bulk of this webinar's discussion we'll try to focus on. It is the availability of manpower in the senior management team, which is capable enough to execute successfully these S curves as new initiatives at the ground level, right? It's one thing to ideate about an initiative, but it's a very, very different thing to execute it successfully. For successful execution, usually you need high quality talent being groomed internally that rises up through the ranks to lead new initiatives and provides both continuity and scalability to the strategic decision making of a business. So let's go through that with a few examples here. So for those of you who've read Jim Collins's work, right, Good to Great, Built to Last, quite a few interesting books written by Jim Collins. There's a very interesting quote which this slide mentions on the left, that if you are the senior management member of a large company, your company should be having long-range succession planning processes to ensure smooth transition from one generation to the next of management layers, and that defines sustainability of greatness of firms which are built to last. And it's always better to promote insiders than to recruit laterally straight into the senior management roles, people who will provide continuity to strategic decision making. Now, there's actually not just continuity which is important that this quote obviously focuses on. There's also the second dimension, which is scalability, right? Not only do you need long-range planning to provide continuity to the CXO layer, you also need long-range planning to provide scalability to the CXO layer, right? Now, what do we mean by scalability? So you will always have a hierarchy in an organization, a triangle which will have one leader at the top. But what you need is not just the long-range succession planning providing continuity to that senior leadership, but also scalability, because once new initiatives, disruptive, innovative, peripheral are ignited, the execution of that might not be possible by just one man who's also taking control of the core business. Now, before we go deeper into that, why is this important, right? So why is this relevant for investors who are listening to this, investors who are investing in consistent compounders? This quote from Michael Mauboussin, right, a renowned professor, a renowned expert in the field of valuations. He wrote a bunch of papers. He, in fact, also wrote a book called Expectations Investing, a revised version of which has come. And in all these papers and his books, he has talked about how longevity of greatness, how the duration for which competitive advantages can be sustained by a firm, it contributes to creating higher and higher intrinsic value, and hence opportunities of capitalizing on undervaluation of great quality businesses. So in effect, he's taken a Kellogg company example here by saying that if Kellogg grows at 10%, and this is back in 1997, he stated that if Kellogg grows FCF, free cash flow, by 10%, and assuming 11% weighted average cost of capital at that time that he took, then 15 years of longevity provides for justification of the current share price. And if you thought that Kellogg's won't last for as much as 15 years with its competitive advantages, then let's say 10 years of longevity, row number B, required more than 10% free cash flow growth. Now, if you as an investor believe that Kellogg might not last for as long as 15 years, but you can't see how it will grow at a rate faster than 10%, you'll find it overvalued at $70 in 1997. But if you could see Kellogg growing at a rate of 10% for longer than 15 years, then the $70 becomes a pretty cheap share price to invest in, right? So that's the context that he provided. The table on the left and the quote on the top of this slide. When you put that into a simple framework, the way we use it, let's say for our portfolio businesses, if you use a 12% cost of equity, let's say in India, and this is the table on the bottom right, if you use a 12% cost of equity in India, and then you create a 2x2 matrix of rate of growth of fundamentals and the duration of this growth before it fades to the terminal level or before the competitive advantages they fade away. If you then build that 2x2 matrix, simply put, a company that grows, let's say 20-25% in its free cash flows or earnings, and you expect that growth not to last beyond, say, 5 or 10 years, 20-30 times PE multiple, 25-35 times PE multiple will be very expensive for that business. But the moment you start going to the bottom right of this table, where if you expect the business to compound at a healthy rate for longer than 10 to 15 years, then the implied PE is the intrinsic PE, right? The intrinsic PE, the fair value PE multiple of the company starts ramping up non-linearly, right? And this non-linear ramp up of PE is what is an opportunity for an investor, provided you are correct in assessing the sustainability of greatness in that kind of a time horizon, right? So that's really the biggest source of undervaluation in high quality businesses, such as the ones we invest in via consistent compounders. And this greater longevity period that the investor might expect compared to what the market is factoring in becomes the biggest source of undervaluation in high quality consistent compounders, right? Which is the bottom right part of this table. Now, the question then is, how do you grapple with the challenge of being able to forecast continuity of greatness or sustainability of greatness beyond the next 5 or 10 years? Which is where all of these capital allocation decisions and their ability to get executed at the ground level through S curves, it comes back into the picture, right? So when you look at this triangle on the left, right? This we call it, let's say, the corporate hierarchy triangle. Many of you would have seen such a triangle in various organizations that you've worked with. For a decadal compounder, it evolves as new growth drivers are incorporated, right? The base of such a triangle is narrow in the initial years, with 1 or 2 business heads reporting to the company's CEO. But when new growth drivers, they start getting added through innovation, through disruption, over several decades, the base of the triangle, it expands. The requirement of new leaders arises, who are then assigned the responsibility to lead new business verticals. And as the core segments, they become a cash cow for a company like this, having internally groomed new business leaders becomes a very key element for increasing the success probability, the probability of succeeding in S curves in new initiatives. Because these leaders, these internally groomed leaders, usually have been in cross-functional roles in various parts of the firm. They are well versed with the company's ethos. They are well versed with the company's capital allocation discipline, its competitive advantages, its corporate governance practices. And hence, when they are empowered, when these internally groomed leaders are empowered, after having worked with the firm for 15, 20, 25 years, to become CXOs of new initiatives, the probability of success of these new initiatives it jumps up several fold, right? And that's one very, very important element that needs to go into an investor's expectation or lack thereof of sustainability of greatness into time horizons such as 10, 15, 20 years into the future, right? So that's how we expect great businesses to deliver on capital allocation decisions using internally groomed leaders to run S curves, which are new initiatives in an organization. Now, let's go through a few examples which might give you a color of how this has been executed. This kind of S-curve success through internally groomed talent has been executed time and again by firms globally as well as locally in India, right? For those of you who are following our colleagues in Marcellus on the Global Compounders Fund, would be aware of some of the tenets that we keep tracking in some of the companies that we have under coverage. Amazon is one such company that we have under coverage in Global Compounders. It has widened its offering beyond e-commerce into areas such as Kindle, Prime, Amazon Prime, AWS as a cloud offering, advertising, right? Quite a lot of widening of the offering has happened in the last couple of decades. The management bandwidth expansion needed for this was not met through lateral hiring at Amazon, right? These are two examples we've given on this slide. So Steve Kessel, who had been looking at Amazon's physical books division since 1999, he was asked by Jeff Bezos to build an e-reader, ebook reader around 2004, and Kessel he brought out the first Kindle in 2007, which has since driven Amazon's dominance over the digital books market. And later, Steve went on to lead Amazon's offline store foray, as well as have an oversight on the Whole Foods market, an acquisition that was done, I think, in 2017, which is roughly $19 billion in revenue today. So that's how Steve is an example where a key talent individual rose through the ranks, worked in different parts of the organization and led various new initiatives, brought them to success. Jeff Wilk is another such example. He joined Amazon just 5 years into its inception to handle the logistics operation. And over the next few years after his joining, he redesigned the logistics chain and introduced the concept of fulfillment centers. Simultaneously, software and infrastructure, custom software and infrastructure were built as vendors weren't able to handle Amazon's scale, and these were built in-house, something that enabled Amazon to introduce super saver shipping. They have this super saver shipping being offered since 2002. And eventually, as costs of fast shipping were brought down at Amazon, Prime was introduced in 2005. So in effect, Jeff Wilk was a key contributor to Prime being introduced in 2005. And eventually, he went on to lead teams that launched the Prime Video, Prime Now, Prime Day, Amazon Fashion, and many other innovations that are now part of the broader Amazon offerings, customer experience. And now he's the CEO of Amazon's overall consumer business, which is roughly 80% of Amazon's revenue in 2022. So that's one example. Google is another great example for those of you who are aware. It has transformed from being just a search engine 2 decades ago to into digital advertising, YouTube, and various other such verticals. It has always been considered a powerhouse of successful business incubation for the bulk of its 25 years of history of existence. I remember it used to have an innovation time off. I think that's what they used to call it, innovation time off policy, where Google engineers were encouraged to spend 20% of their work time on projects that interested them. And this had led, in the first decade of Google's existence, this had led to origination of services such as Gmail, Google News, Orkut, AdSense, etc. And all of these future leaders at Google, running all of these initiatives, they are internally groomed. Again, two examples on this slide. So Susan, who's currently the CEO, currently the CEO of YouTube, had joined Google in 1999. And in 2003, she was the first product manager of AdSense. Later became Google's senior vice president of advertising commerce, advocated the purchase of YouTube and various other such initiatives. And her predecessor, Salar Kamangar, went through various such new initiative successes internally in Google. Likewise, right? Today, AdWords is an outcome of Salar and big part of the profitability engine at Google advertising. Very interestingly, LVMH, Hermes, the luxury brands, their success also has been an outcome of something very similar. If you look at this table, these are the top 12 executives at Louis Vuitton, Moet Hennessy, LVMH, including the chairman, founder, Bernard Arnault. Out of the 12 executives, only 2 are from the promoter family, 10 are professionals. And the average tenure of these 10 executives at LVMH is roughly 20 plus years. Now, what has this done? This has helped LVMH become a conglomerate of a size which is unprecedented in luxury industry globally. And interestingly, that size is not becoming an impediment against growth of LVMH. So LVMH is actually a conglomerate of 75 very powerful luxury brands such as Louis Vuitton, Christian Dior, Hublot, Bulgari, Tag Heuer, etc. Most of these brands have been acquired over the last 30 years. And when you look at the size, in 2019, LVMH was as big as $54 billion in revenue. And for those of you who might get worried about great companies becoming too big to grow, people call it, can elephants really dance? After $54 billion of revenue in 2019, LVMH acquired Tiffany in 2020 and turned it around successfully, right? It wasn't the case that it couldn't find large acquisitions. Tiffany was actually $16 billion worth of acquisition in 2020. It found a large acquisition, turned it around successfully. The success rate on acquired businesses being turned around at LVMH is significantly high. And one of the main reasons for that is that the people who execute the turnarounds, they are all internally groomed. Similar to Google and Amazon, the professionals are empowered here. They lead various initiatives within the organization, and they get bigger and bigger responsibilities over time. In response, the group keeps executing on S curves without stagnating. Right, quite a big example. In fact, in one of our primary data checks that our global compounders team did, we were told by the executive that we were speaking to that when you compare Kering, the owner of Gucci, a competitor of LVMH, when you compare Kering with LVMH, there's a big difference in the degree of empowerment of executives. Where at Kering, other brands, they leverage on the strengths of Gucci and they will apply tried and tested success recipes from Gucci to sister brands. Whereas at LVMH, every brand develops its own business strengths, and entrepreneurial stewards of each brand, they become they sort of have smart things to do before they tap into synergies. They create their own strengths of their brands. If needed, they tap into synergies. But broadly speaking, LVMH has brands that keep getting developed, business strengths that keep getting developed from bottom up to turn around acquired assets, right? So that's those are the examples from global compounders. Many such examples exist from Indian successful stories as well, some of which are part of our portfolio. So Asian Paints, many of you would know, is a company, is a large exposure in our consistent compounders portfolio. It's a great example of having executed these S curves through internally groomed talent. Remember, Asian Paints is well over 50% market share in paint. So this is actually the biggest candidate of hitting the ceiling, hitting the saturation point, because it's too big within the size of the industry in which it operates when it comes to only the paint business, right? But the benefits of internal talent grooming here have been very clearly visible over the last 2 decades. And if you look back at the last 2 decades, the firm has totally transitioned from what it used to be to what it might become, in order to avoid potentially some of the risks of stagnation that it might face in future. So the first phase in the last 2 decades of Asian Paints was where in the noughties, it had less than 50% market share. Its overall revenues were, I think, in before this decade started, not even 5,000 crores. And the firm had enough scope to increase market share. That's what it did. 19% was its revenue CAGR under the leadership of PM Murthy. And that was when the profits were also growing at about 20-25%. But that's when it came to about 10 years ago, Asian Paints had started exceeding 50% mark on the market share, which is when its second phase of evolution started, where it started germinating S curves, started planting seeds of S curves. So whilst the paint business, it continued to remain the core, Asian Paints did 2 things. One, it kept innovating. It kept creating new areas of efficiency within the paint business, took the margins of Asian Paints from, I think, 16-17% to 21-22%, drove growth of the paint business's profitability through that. But at the same time, started expanding into adjacencies in home decor and waterproofing, putty, etc., etc. And 2 people from the senior management team were given ownership of these new initiatives. And by the end of KVS Anand's tenure in 2020, the paint business on the one hand had become highly process oriented with a lot of automation and several S curves. Seeds had been sown, some of which grew in the subsequent period of 3-4 years under the new management under Amit Singhal. So if you look at the last 3 years, Asian Paints has had 10 out of its top 25 CXOs, right? And CXOs defined as AVPs or GMs. 10 out of the top 25 CXOs are directly working on one of the new business divisions that Asian Paints has created in the last 3 years. All of these executives have been with the firm for over 15-20 years. Some of them have been with the firm for 25 years. And whilst these businesses, they contribute to less than 5%, some of these can actually potentially be the reasons why Asian Paints' growth rates might not stagnate despite well over 50% market share in the paint industry. And you can see some of the names, some of the positions, and how some of these individuals have gone up the ranks. It's a powerhouse of CXOs, where even if a few of them leave for quote unquote greener pastures, there's enough talent pool available to take control of decision making, provide continuity, and at the same time scalability through S curves execution at the ground level. Titan is another great example on this subject. If you remember, Titan 2 decades ago was 3 decades ago was largely only a watch company. Until 5 years ago, it was largely just a jewelry company, and today it has transformed quite radically. When you look at how it has happened, so take, let's say, Ajoy Chawla as an example. Before he became the CEO of the jewelry business, he had multifaceted experience spanning watches, international business, strategy function, and Tanaira, the Sarees venture. And then he took control of jewelry. He's been with the business for more than 30 years. And hence, when CKV stepped up after the retirement of Mr. Bhaskar Bhatt, Ajoy Chawla filled into the shoes of CKV on the jewelry side, and various other leaders from different parts of the organization. They started expanding beyond the core jewelry business, various other lines such as eyewear, Carrot Lane, Phygital, and Tanaira, and a few other new concepts that have been germinated. And this is not something that is new to Titan. If you look at, let's say, Ronnie Talati, who's now retired from Titan, but who started in the finance team. He went on to head Fast Track, then became the CEO of Eyewear before his retirement. And his successor, Soumen Bhaumik, he started his career in jewelry at the manufacturing plant, in fact, in Hosur. And then he went on to become the person responsible for driving Golden Harvest scheme, which was a very big part of competitive advantage at Tanishq. And he's today the GM of retail businesses at Tanishq. Overall, the firm has totally transformed from being just a jewelry franchise 5 years ago when it comes to profitability to several S-curves contributing to profitability through their successful execution, such as I mentioned, eyewear, Carrot Lane, wearables. Wearables is now, in fact, growing, and Titan appears to be getting its dominance back in watches and wearables as well in the more recent past, right? Again, big reason is the talent pool, not just the decision making from the top in terms of which new S-curves should be germinated. It's the talent pool which executes this, takes them to the success. And finally, let's take this as one more example, Kotak Mahindra Bank, where the need for institutionalization of its group's HR practices was realized as the bank expanded from being a brokerage to becoming an investment bank, then getting the banking license, so on and so forth. And Kotak developed its leadership platforms, such as Kotak Leadership Team, they call it KLT, Kotak Initiatives Team, regional forums, and many other such forums which promote cross-functional reach of leadership across the organization. It's a conscious effort to take talent through different parts of the organization as they grow up the hierarchy. And much like Titan, Kotak also believes in moving leadership across function as a result to retain its best talent and foster their leadership skills. That's a bunch of examples. We track them. How does all of this link into the philosophy execution of consistent compounders? So as Pramod mentioned in the beginning, this longevity framework is something that many of you might be aware of in terms of how we follow it, where we try to make money by investing in companies where the right half of this slide, the right half, which is the sustainability of competitive advantages and their drivers, they are underappreciated in the share prices via, let's say, the Michael Mauboussin concept, where greatness, if it is underappreciated in terms of the sustainability of the competitive advantage period, it provides a significant room for investors to make money through investment in companies which have already been great in their history. And the right half of the slide has two parts to it: the tangible capital allocation piece, which is the lethargy score, and the intangible capital allocation piece, which is the succession planning score. They are intertwined. You can't have a business execute capital allocation decisions decade after decade in a very successful manner without also having a very significantly high quality talent pool available at the board level, at the CXO level, and long range succession planning of the CXO layer right from the bottom up in the firm's hierarchy. So that's something that we do very consciously, and most of our CCP companies derive their source of undervaluation in the share prices because of the underappreciation of this piece about longevity of growth, which we try to capture here. So I'll stop here, and maybe we can take some questions that we've got. Pramod?
Yeah, thanks, Rakshit. Very interesting. So folks, we will take questions. If you have questions, please do put it down in the Q&A box at the bottom of your screen. We'll start with questions revolving around the topic of this webinar before we get into questions about the portfolio and specific portfolio companies. But feel free to put them, as and when you'd like to put them. So here's an interesting question, Rakshit. The question about, the multiple S-curve generation and management is a great idea. Whilst there are multiple examples in the past, how do you get transparency or visibility into emerging S-curves in future inside the consistent compounders? I suspect that will be guarded very closely. And there's a follow-up in the sense, once you get visibility, how do you assess the effectiveness?
Yeah, so particularly for businesses which are B2C in nature, this can be done by tapping into the ecosystem of these businesses, by doing channel checks to begin with. Right. So I'll give you an example. Some of the S-curves don't necessarily have to be new product launches always. They might even be new supply chain efficiencies, new ways of utilizing tech to meet the consumer requirements, customers' requirements in a better manner compared to your competitors, so on and so forth. So whether it be about new products or how the new products are being sold, there can be several data points collected, provided you have your ears close to the ground, which we try to do. We've got a team of more than 20 analysts who pretty much throughout the week, throughout the month, they try to keep tabs on what new initiatives are being executed at the ground level by the companies under our coverage. For B2B companies, it might be that only after such an initiative has been highlighted in the annual report, or if we get to speak to an ex-employee who talks about how the thought process behind these initiatives happens typically inside the R&D engine of the company, might be able to give us some insight into how the germination of these S-curves happen. But this is just about the germination. What is way more important is how, from the germination stage to successful execution stage, focus of the senior management is visible to us. What are the ways in which we can assess whether there's a process behind it, and hence joining of the dots in terms of various steps taken to roll out new S-curves and scale them up, that we collect from the ground level. This is largely done by tapping into the ecosystems of our portfolio companies. The biggest source of understanding that we get is by tapping into the ex-employee piece, where if in a consistent compounders case, longer than a decade of greatness has persisted, there is a very high probability there will be too many people who have retired from these organizations or left these organizations to join other places, who might be able to help you understand how the thought processes internally are working. So it's a combination of things at the ground level, things that get reported, and things that we pick up from our conversations with people who might have worked at these firms till 5, 10, 15 years ago.
Rakshit, for those who are listening and those who don't have access to the sort of network you have access to, right? So say a typical client of ours who only has access to annual reports. I think if they were to do it, I suspect there are 3 ways to use annual reports to get a grip on these S curves Rakshit is referring to, right? As Rakshit mentioned, he has access to a very powerful network through our client base, through our contact network in India, into the ex-employees of many of these firms. But if you read annual reports, there are three things I think you should look out for. Firstly, look at the reinvestment rate of the company. So the reinvestment rate is, you go to the cash flow statement, look at investing cash flow, CFI, divide by operating cash flow, CFO, right? So a company which is heavily reinvesting, where investing cash flow is a high proportion, 60, 70, 80% of the operating cash flow is getting reinvested in growing the business, the probability is much higher that there'll be lots of S curves, because the company is pumping in so much cash into growing the business going forward. Second thing to look forward is look at the board composition, and take 10 years of annual reports, note the board composition each year. Companies which are good in retaining talent will have very steady board composition, barring the statutory need to rotate non-executives. High quality companies seldom have heavy rotation in executive directors. So if you take a TCS or an Asian Paints annual reports, you will see that the board fundamentally stays stable over a decadal cycle, right? So that's the second way to see that this company is retaining good people. Thirdly is, in any annual report, they'll also have KMPs. They'll have the names of the KMPs, they'll have ESOP grants, they'll have compensation data on the KMPs disclosed in the annual report. If you see that the KMPs are stable, and you can see that KMPs are progressing from small ESOP grants, over the years they get bigger ESOP grants, that's a sign that their responsibilities are escalating, right? Sometimes you'll be able to see that the job title itself is getting escalated. Then though it's easy to see that youngsters having bought in, groomed, middle management, senior management, ultimately CEO. So these are a bunch of things which you can get from the annual report itself. Obviously, this requires close reading of the annual report. But if you don't have the sort of network that my colleagues have access to, the annual report itself can be a big source of data on S curves. And if you go and look at Titan's annual reports, Kotak Bank annual reports, Asian Paints annual reports, they'll tell a story of their own about the S curves that these companies are on.
Right. So there's a few people asking about the succession planning piece as well. I guess there is a combination of annual report and primary data, particularly around how do you know beyond the key management personnel, for example, how do you know that the company has a very strong talent development program to be able to grooming internal leaders pretty much all the way down through the pyramid, beyond what we see in the annual report, so that we can derive comfort that whatever S-curve initiatives they might have, they also have the ability to execute on those initiatives.
Yeah. So, I mean, I'll give an example of how, if you ask the right question to yourself when you read an annual report or when you speak to an ex-employee or channel partner, you might start getting the answer to this. So there are two ways of trying to understand business execution at the ground level. One is, let's understand what is the situation of a particular business at the ground level, which is where you just let's say go and try to find out whether Tanishq is able to sell jewelry in a particular geography or not. Go and find out whether Nestle is able to sell infant formula milk on e-commerce or on the high street or not. That's one type of questioning where you're trying to understand what is happening to the business at the ground level. This will not tell you anything about succession planning, software aspects, etc. But if you go with the intent of trying to understand why it is happening the way it is happening, the shift of your questioning of your mindset from what is happening to why it is happening becomes a very big starting point. So if you meet a retailer, let's say selling a particular product of a portfolio company for you as an investor, if you try to ask that, tell me what has changed in the last 5 years in terms of the area sales managers team interacting with you. Who has driven that change according to you? When was that change implemented? Was it done with a great degree of thought behind it, or was it done in an ad hoc manner? If you start from there and then you start building up onto that understanding that if the person driving the change is doing it in a process-oriented, systematic manner, and it is not just a key individual, it's a collection of individuals up through the hierarchy who are executing a new initiative, that becomes a starting point. The same exercise you can also do. You can also do top down and try and understand from, let's say, an ex-employee, or by looking at the annual report, what key initiatives did a particular individual implement for that person to get rewarded in the bigger scheme of things in the overall organization. It will give you a sense of whether there is meritocracy or whether there is lalagiri. It will also give you a sense of whether incentive structures are driving retention, or whether there are no incentive structures, and hence success happens by luck and hence is not repeatable. So both from the bottom up as well as top down, if you try and understand why things are working out rather than whether things are working out or not, you start to get those answers, and rest of it is nothing but rigor. When you go on the street, when you read the annual report, as Saurabh mentioned, the annual report actually is nothing but a movie playing out in front of you, but not all of it together. There are too many different parts. You have to join the dots. If you link the ESOP plan with retention of key individuals, if you link the background of the board of directors with their time of coming on the board and certain new initiatives being announced, if you link the backgrounds of 20-year internally groomed talent, how they have gone up the ranks through various parts of the organization, what has been their success milestones in the last 20 years, you will start forming a picture. There will be some organizations where whenever a new initiative gets introduced, the CXO is someone who has joined from a competition, right? Whereas there will be other organizations where every time a new initiative is introduced, the CXO is a lifer who has spent 20, 25, 30 years at the organization. And that's a consistent pattern, right? Some of those inputs help you frame the hypotheses on this front.
Great. So related question in terms of, do we see any sort of market differences in succession planning between family-run businesses versus professionally run businesses? And how do we factor those differences in our framework?
This is a very beautiful question. So I'll give you two extreme examples first. The intuitive answer is that family-run businesses must not be doing succession planning of professionals, and professionally run businesses might be doing it. But let me first start with some polar opposites. Most MNCs in India obviously are not family run, but most MNCs in India undergo a massive succession challenge where the CXO who's delegated to head the India office is given 3 years typically to stay in India, and after that CXO will be moved to, let's say, an Indonesia or a China or an Africa or Latin America or maybe Europe or America, right? So the CEO comes with a 3-year project. The first 1 year, 1.5 years of this CEO, it goes into settling down. The last 6 months, he's not interested because he can see the end of his tenure. He gets hardly 12 to 24 months to execute any initiative, which is too short a time for any initiative to be successfully executed from germination stage to its finality. And hence, despite a complete professional way of appointing a CXO for a particular country, most MNCs, they lose out on the opportunity of internal grooming, germinating an idea, an S-curve, and then taking it to its fruition. At the other extreme, there are some promoter-run, family-run businesses. Mind you, Asian Paints is a business which was always promoter-owned till 2 decades ago, even promoter-run. And Asian Paints has had great professional talent pool being empowered, groomed, given new S-curves execution, and taking them to their successful outcomes. So Asian Paints was a promoter-run business, but still it managed to empower professionals throughout the time period when the top roles of Asian Paints' management team were controlled by the promoter family members. So there are two polar opposite examples. So you can't just simply do a stereotyping that if it's a promoter run business, certainly succession planning will be compromised. And if it's an MNC, which is an extreme example of professionally run business, then certainly succession planning will be doing great wonders. What you need to figure out is things such as, what is the culture in a board meeting? Is the promoter empowering other members of the board to speak out their views, their opinions? Can other members of the board shoot down the suggestion given by a promoter in a board meeting? That's far more important than whether the promoter is the CXO or not, himself or herself, right? So that's one very important element. The next important element is, is the next generation of the promoter family members rising up through the ranks in a meritocratic manner, or are they straight away graduating from college and landing up as CXOs in the organization without having earned the respect, without having learned the law of the land, without having gotten their hands dirty, and they straight away sit as CXOs, become bosses of professionals who have spent 20 years creating a few S-curves, but then it all reports into Lala culture. Is that the case of how the promoter manages? And hence, it is not a simple, straightforward answer here. The answer lies in the finer details of assessing the culture of the board, assessing the culture of the CXO layer, the quality of the CXO layer, and the HR practices of grooming talent, retaining talent, and empowering talent with S-curves. It can happen with promoter and organizations, as well as it can happen with professionally run organizations.
Great. Now, in terms of the longevity period, how do we actually, there are a couple of questions around it. One is, how do you sort of back out the longevity that the current price is factoring in?
Right. So I'll give you a few rules of thumb that we follow internally. So if you look at Nifty 50, or even if you look at S&P 500, a typical company in Nifty 50 or S&P 500 stays in the index for about 16 to 20 years. Why do I say that? Every decade, Nifty churns by 50%, which means roughly every 2 decades, Nifty churns by almost 100%. And hence the average duration of a company in Nifty 50, the average duration of a company in S&P 500 tends to be somewhere around, say, the 20 years mark. If that is how companies in the index, and assuming indices are representative of dominance of at least some degree of greatness sustained, then an average company which is great, should not be assumed to have a 5-year longevity attached to it, right? So that's one part of the quantification. The second part of the quantification is, even if you look at the, let's say, the least risky asset considered, let's say government of India or government of the US bond, if you were to consider that, right? Even the government of America doesn't issue longer than 30-year duration bonds. And hence the least risky asset also doesn't have more than a 30-year longevity attached to it in a way. Right. So on the one hand, you have the average somewhere around, say, 16 to 20-year mark. The upper end might be 30. And obviously, any company which is doing all right today might have only 2-3 years of longevity before it gets disrupted, or even shorter. So those are the outer bounds. Now, if you then scale all of these initiatives, right? The moat score is a way of scaling pricing power. Lethargy score is a way of scaling capital allocation initiatives. Succession planning is a way of scaling institution building initiatives. If you scale all of these initiatives, these are in a way risk mitigants against disruption, against stagnation. These risk mitigants, if they tell you that that the company is above average amongst all high quality businesses, then going back to the Michael Mauboussin construct, let's say, saying that 20% growth will sustain only for 5 years or 10 years of a business where you can see several S-curves in capital allocation decision making, of a business where you can see several talent grooming processes which end up helping improve the success rate of S-curve execution, saying that this business might stagnate or saturate in the next 5 or 10 years and hence a 30 times PE multiple is the fair value, is probably underappreciating greatness here. So in consistent compounders' case, talking about history to begin with, historically, free cash flows have compounded at around 25-26% over the last 10, 15, 20 years. Some of you might have seen these numbers in our previous communication, right? So if that's the rate at which greatness had compounded in terms of fundamentals of these companies, your future forecast or your expectation might be slightly different or the same as this. But provided the company is scoring very well on pricing power, on capital allocation, on institution building initiatives, that's where the scaling and hence quantification more towards the 10, 15, 20-year duration rather than 5, 10, 15-year duration becomes the part of Marcellus's process. We use a DCF to do this. In our DCF, 2 inputs we don't try to debate too much about. One is the cost of capital, because if we are running a quality control coverage universe where we are not trying to pick up the worst capital allocators, we are actually trying to pick up from amongst the best capital allocators a small subset, which is our portfolio, then our entire coverage universe is representative of high quality and hence not two different cost of capital assumptions that go into the DCF. The second piece is, if we don't see massive risks of overnight disruption, let's say in the tech industry, we do see massive risk of overnight disruption. In some of the financials, we do see that risk, but not everywhere. If we don't see the massive risk of overnight tech disruption, then the terminal growth rate in the DCF also is a number that we don't significantly debate about, because we believe that zero volume growth in terminal and ability to pass on inflation is what these companies will do. What we are then left with in the DCF is rate at which free cash flows are expected to grow in the foreseeable future and duration of the foreseeable future defined by that scaling of moat, lethargy, and succession. And when you combine these two inputs into the DCF, different levels of intrinsic value for different companies come out. compare that against the current price, and that's the margin of safety and sustainability, we call it internally. Higher the margin of safety and sustainability, higher is the position size. In effect, that's where a succession planning as an input via the longevity of cash generation, cash compounding, goes into the intrinsic value, margin of safety, and hence position sizing in our portfolios.
So Vivek has a couple of follow-ups on that, pretty quick ones. One, who decides the longevity? How does the Marcellus team? Is it done by one analyst, or is it like a group of people? How do you tend to agree? And secondly, what's the range of longevity in years that we see across our portfolio companies?
Yeah, so the decision is through a group. No single individual here decides the number, as in the analyst, neither the analyst nor the fund manager nor someone else in the firm decides on what number of years of longevity will a particular business have. There is a very granular breakdown of all of those elements of moat, lethargy, and succession that the analyst has to quantify basis qualitative and quantitative inputs that the analyst brings to the forum. And then there's a proposal from the analyst team. That proposal gets debated against, gets defended by the analyst, and we arrive at a consensus. There's a voting mechanism internally in Marcellus, and we arrive at a consensus, and we try to challenge ourselves. There are various forums, various mechanisms in place to ensure that we are not being biased by the looks and appearances of some of the businesses, their management teams. We are not getting biased by our successful investing journey historically with those companies. We are not getting biased by some of the other apprehensions we might have had about the business 3 years ago, 5 years ago. In order to break those biases, we have some consciously put processes which are implemented in our research teams to ensure that is the group which helps arrive at the longevity number, the free cash flow compounding number, rather than any single individual.
And the range?
So the range is, if memory serves me right, 5 to 6 years is the lowest longevity period across our coverage universe, and the highest is a little over 20. Average is 15 or 16. That's the implied longevity period.
Okay, this question was bound to come. When we talk about disruptions, how are we assessing companies in our portfolio factoring in or ignoring AI as a source of disruption? Do we even look into it? How do we go about assessing?
Yeah, no, so tech in general and AI in particular is in a way the route to answer this question. AI is not a standalone tool. Ability to understand technology, ability to use it to build competitive advantages is a long drawn process. Businesses which have been run without tech orientation in the mindset of management teams, and hence let's call them traditional businesses, they can't overnight take up an AI tool and transform their business, right? So tech is a way of life when it comes to executing and disrupting businesses, whether it be AI or prior to that ML or prior to that big data, data analytics, or prior to that, point of sale ERPs or something like that. That's a journey. We need to see first and foremost an intent to go along this journey in the past from the firm. This, as I said, includes being process oriented first, then upgrading to system orientation. If companies don't do that, then we give them a severe penalty in our capital allocation. And capital allocation decision making captures tech, systems, and processes as a separate portion of scoring for these businesses when we collect those data points, right? We actually wrote a newsletter on this about a year and a half ago, where we gave different stacks of technology, right? So there's the ERPs, there's the demand forecasting, there's the supply chain automation, there's the customer interface. Technology can be implemented at any of these 4 levels, whether it be AI or ML, it can be implemented at any or more of these 4 levels. Not just having a consumer app with AI functionality built into it can help you build competitive advantages. If the manufacturing of the business doesn't get linked with the consumer app at the front end, for instance, then there is no business built, even after having adopted AI, right? So these are the 4 layers: ERP, supply chain automation, demand forecasting, customer interface. Broadly speaking, across these 4 layers, we need to see action. We need to see action where the management team rewires the thought processes, their ability to understand tech, implement it, and then take it forward. And then, last but not the least, we want to see any evidence of using tech to create value adds, whether it be via AI or otherwise, which is where we give scoring. Not all companies in our portfolios are equally capable on adopting technology and AI. But yeah, the larger allocations that you see in our portfolios are more tech-oriented businesses. The smaller allocations that you see in our portfolios typically are less tech-oriented. And the reason for that is our longevity gets pumped up for a company which is using tech to disrupt, and our longevity gets pumped down for a business which is just putting up factories and not using tech within those or elsewhere to disrupt.
Right. So the last question on the subject before we get into stock specifics, we'll take 3 questions on that. The last question is, presumably this style of investing is subject to lots of periods of pain where these are not obvious for the market, and hence the stock price could just remain stagnant or perhaps even correct over extended periods of time, while the S curves are at work before they start feeding into earnings and cash flows, and hence the market appreciates the longevity better. Is there any way to sort of get a grip during such periods and give yourself the comfort that the consistent compounder will eventually compound?
Yeah, I mean, what we do, and there are several examples, I'm picking up these slides from some of our previous webinars. There are several periods of stagnation of the share price, several periods of corrections in the share prices, and Bajaj Finance here is a great example of corrections. So there are periods of pain, and in fact, I'm sure most of you on this call would have experienced till 3 or 4 months ago, the preceding 12-month period, so let's call it FY23 entire 12-month period, was actually incredibly painful in that regard. We delivered a negative return in FY23 on our portfolio, which is not something that we would be comfortable with. And we delivered that negative return in FY23 despite the fact that FY23 profit after tax went up by 20% in consistent compounders. That was quite a painful period, I would say. What do we do during these periods? First and foremost, we double down our efforts on trying to understand the ground level evolution of the business, right? So for instance, whether it be the e-pharmacy disruption attempted in diagnostic space, which led to Dr. Lal Path Labs share price crashing about 15 months ago, or whether it be Divi's Labs' lack of molnupiravir revenue leading to Divi's share price correcting to half in October, November 2022. We doubled down our efforts on companies like these at those times to just ensure that we are not unaware of any deterioration in fundamental quality of the underlying franchise, and just to ensure that whatever is happening in terms of reported weakness for maybe a quarter is temporary, right? So that's the first bit. Wherever there is weakness in fundamentals, although the broad portfolio delivered a 20% PAT growth, not all companies delivered a 20% PAT growth in FY23 for our portfolio, and we doubled down our efforts wherever reported financials were weaker than expected. The second piece is wherever we kept getting very positive feedback, either through reported financials or from our ecosystem checks, primary data checks, usually a combination of both. If we get a lot of positive feedback in terms of how the business is using COVID as a crisis to its advantage, how capital allocation decisions are creating new S curves, but the share price is not reflecting some of those S curves, some of their successes, some of the key decision-making positives. In those cases, we double down our allocation to these companies. We increase our allocation in the portfolio wherever share prices have disconnected more from fundamentals. The objective here is that provided fundamentals, we are reading them correctly, share prices will catch up with them, and when they do, are having doubled down on their allocations in the portfolio will benefit our clients. That's what we did. And in fact, if those of you who are our clients listening to this, FY23 was a period where we didn't change anything in CCP in terms of list of stocks, but there were several instances of changes to allocations. Most of those instances of changes to allocations have started paying off. For instance, increasing Divi's Labs' allocation in November, increasing Dr. Lal's allocation earlier in the year, so on and so forth. Many of these allocation changes have started to pay off, usually over a 1 to 2 year period as share prices they catch up with fundamentals. These allocation rebalancing exercises, we call them, they add significantly to the long-term compounding of the portfolio. So those are some of the measures we put in place, but end of the day, we keep a long-term view, right? So for instance, if you remember having gone through this slide, the left half of this panel is what might be the concern because of which share prices are not moving up. But the right half of the panel is what we try to understand, track, get convinced about. And hence, it's the disconnect we try to keep in our minds between the left half and the right half consciously is what we do in order to stay patient when our patience is getting tested.
Right. Just a couple of stock-specific questions. HDFC Bank, obviously the stock hasn't done much over the years, yet the fundamentals have compounded quite strongly. Specific question is there something that we're missing, particularly given the merger that's been consummated this month? Is there something that the market seeing that we are not, or perhaps what exactly do we expect from this merger?
Right. So the stagnation of the share price actually has been happening way before from time periods way before the merger as well. Initially, the concern was from Aditya Puri to Sasidhar Jagdishan if the transition is going to go out smoothly. It has. Next was HDFC Bank's mobile app was not working. The tech was not delivering. There were hiccups, etc. And HDFC Bank's tech actually genuinely lagged behind someone like an ICICI Bank's tech till 3-4 years ago. All of those gaps have been filled up, and in fact, the way we understand it's a very, very differently tech-oriented business today, HDFC Bank, compared to 4 or 5 years ago. So no concerns there either. And then came the next round of concerns, perhaps around the merger. The way we see it, this merger actually has some very, in a way, simple to understand and very powerful positives for HDFC Bank. The first and foremost one is it frees up resources in the bank which can be put to more efficient use. So for instance, prior to the merger, the average tenure of the book of HDFC Bank was 1/4 the average tenure of the book post the merger. The reason being, home loans were not a large part of HDFC Bank's loan book. And today, home loans are a large part of HDFC Bank's home loan book. The increase in the tenure means that, to put it very simply, in order to grow the loan book by say 20%, instead of disbursements running at 50-60%, now the disbursements need to run at probably 30%, right? Because when the book is running off on an average in 2.5 years, let's say, the runoff in a particular year is significant, and hence for the loan book to keep growing, disbursements run rate has to be very high. To put it in an analogy terms, it was a car, a four-wheeler running at, let's say, 60 or 80 kilometers per hour in third gear, right? Now, suddenly, when you say that in order to grow the loan book by 20%, you don't need to disburse 50-60%, only 30% disbursements are also going to be good enough because the tenure of the book is pretty long now. Suddenly, you have shifted the gear from third gear to fifth gear without changing even the speed of the car. Or if you want, you can actually change the speed of the car as well. But that improvement in fuel consumption of a car in the analogy, or of resources in HDFC Bank, that improvement in resource utilization is something that is probably one of the biggest parts of low-hanging fruit of this merger. The next bit is then the ability to cross-sell, upsell various group entity products and services via the bank's infrastructure in a better way than what could have been done or what was being done previously, so on and so forth. And hence, there will be a period where, say, for instance, the deposit growth in wholesale banking in the last quarter was a tad lower than the long-term run rate, but retail and SME loan growth was high. The loan book growth. At the same time, deposit growth was weak in 1Q, but very strong in 4Q, FY23. So there will be, as we go through the merger, there will be 1, 2, 3 quarters where some of those line items will go up and down. Longer term view, again, the right half of the slide in front of you remains quite positive in our understanding at the moment, and hence we remain invested in HDFC Bank.
So one last question, stock specific. This is on Page Industries. Clearly, the stock has just fallen off a cliff. There's also accompanied by weakening fundamentals in terms of slowdown in growth. Is this a macro situation? Is this something specific to Page or the industry in question? How are we reading this?
Right. So there are a combination of three factors, the way we understand it at the ground level. One is a little bit of macro slowdown, particularly in the small ticket consumption items. Now, this is something that affects only a part of Page's portfolio, because bulk of Page's product portfolio is mid-premium rather than economy variants. And economy consumption, particularly in smaller cities, in rural towns, is where there's a bit of a macro challenge. But that's not the biggest part. It's one of the contributors. There are two big parts to the weakness in the more recent quarters. One is athleisure, which is track pants, t-shirts, outerwear of jockey. It had shot through the roof in terms of growth and contribution to overall revenues during the period of work from home for larger part of India's population. And hence till end of FY22, when work from home was continuing, athleisure sales were significantly stronger than non-athleisure sales. That created a base effect, which is unwinding now as people resume going back to the office, and hence track pants and t-shirts are less and less in demand now, right? So there's a base effect from athleisure, which until it normalizes, you will see a drag from that. The third piece is their tech interface of auto replenishment system is leading to destocking at the channel level. We've collected our own independent checks on this, and they do corroborate destocking at the distributor level in terms of number of days of inventory that the distributors used to hold till 6 to 12 months ago compared to what they hold today. That destocking means the reported revenues of Page are lower than reported revenue growth of Page is lower than the actual revenue growth from the distributor to the retailer and the retailer to the customer. So that's also a period of reset in a way until the inventory reduction stabilizes at the distributor level. This drag will continue, which might be few more months before it stabilizes. Other than this, we do see there is some rise in competitive intensity here or there in pockets. But as of now, we don't see any evidence of competition meeting a distributor's or an end consumer's requirements and adding value to them in a better manner than Jockey does in terms of availability of product, in terms of distribution, in terms of quality of product, pricing, so on and so forth. So at the moment, we are keeping a very close watch on how the situation at the ground level for Page is evolving. And we'll be taking corrective action on allocations to make the most out of it.
Great. Thanks, Rakshit. With that, we'll bring this call to an end. Thanks to all our clients who've dialed in. Very interesting questions. Wish we could go on and on. But yeah, look forward to the next webinar. Look out for the invite in your inboxes, and look forward to many of you joining there. Thank you so much.
Thank you. Thank you.